So,
Right.
I mean, look, those are the rates that I mentioned to you. But at the end of the day, we're getting 20 plus return percent rates, right? For those kind of fixed income offerings, they have to be lower just because they have to be lower. But if there are people who in your audience want to take on more of a longer term layer, right? They're willing to put their money in for 2 plus years and then start getting distributions. It's almost like a real estate trust, right? You become an LP in the real estate trust. It buys the property. Okay, it's going to take a few years before you get a return. And then that real estate trust will then go out and borrow from the bank.
Mm.
And the bank will get a nice steady stream of income. So what we're essentially offering are the rates that I mentioned to you built before. That's equivalent to what a real estate trust would borrow from a bank.
Right. Right.
So that's what we're offering on one hand. But then there's another where for those who are more, um, that don't care as much about the instant liquidity, they can put their money in for the entire term as a, if you will, LP and earn 21% plus returns.
Uh, okay, so that 21, so let's dig that a little bit. That 21% returns in equity. I mean, I guess it's riskier. There's more risk, but what's the term?
It's technically riskier. So the SPV structures are 4 years,
Okay.
and there are no distributions in the first 2 years, but then starting year three, so month 26, or I'm sorry, I can't do that. Month 25, you start getting disbursements or distributions. Sorry.
Distribution
So
like
yeah,
21% a year or
with a net IRR over the years of 21%. That's correct.
got it. And by end of year four, it's fully exited.
And then by end of year four, fully exited and so on. So, if you're somebody who is willing to wait let's just say 4 years for you to get your money back, but at a higher rate, 20% plus, and that's cash, then that's the option to go. And yes, it is more risk. If you just want fixed income
Mhm.
and you want your money back in a year, then you go for one of the, if you will, fixed income offerings.
Got it. Um, and what's the minimum check for that, for the equity?
It's the same. It's the
Oh,
same. It's really all about just administrative processing. And again, I can't promise the date on this, but we're trying to come up with what we actually have to test whether a Web3 offering makes sense for
yeah.
that layer,
Yeah. Yes.
because it may or may not.
Right. Got it. Okay. Then I guess let me just summarize if I get it right. For both the fixed income and the equity offering, is you need to be accredited investors. You guys will be
Mhm.
launching the token, maybe, outside of US, you can self-represent. But for the most part, you need to be accredited investors.
You have to be a great investor. Yeah.
Yeah. Minimum amount.
And you have to go through a 506C accreditation
Mhm,
certification. Yeah.
mhm. And for minimum amount, you need a quarter million to a mil, depending on the maturity. And I guess the process should be easy. If anybody interested, they can reach out to us, and then
Yeah.
we can just flip over to you, and you can walk them through the process, and I guess give them all the transparent data, the dashboard that you mentioned that you would, since you have all the data anyways, so they will see their portfolio and think,
Exactly.
yeah, okay, okay, this
That's
is
exactly it.
anything else that you should like you want to mention that I didn't ask that you think are important?
No, I think this was a great flow, and I think you covered most of the key pieces of it. I think I think my main point, especially for those who are outside the U.S., we're looking for additional partners to expand to different parts of the world
Mhm.
with this model and with this technology platform. And so, whether you're a individual investor or a institutional investor, and you've seen the kind of companies that I'm talking about, embedded finance companies and so on, and you think that you want to really execute this model in your market, I'd love to speak with them, because at the end of the day, um, our go-to-market strategy is not try to be the operator and expert in every market. It's just not possible.
Right.
Or not. It's just very hard, I should say. We want to partner with local investors who really understand a sector or a market and leverage their local presence and expertise in those markets to find the appropriate kind of companies, and then use our technology to be able to capture a market that otherwise doesn't exist, or I'm sorry, otherwise doesn't isn't accessible, and then really unlock the economic potential of those markets and provide really interesting investment opportunities for global investors.
Then how much do you usually charge them? Like, what's the, I guess, what's the rate you offer to the to local expert? These.
So we want to partner with them, right? So we want to be able to say, hey, look, let's go tackle this market together. And I think the idea is if we help you facilitate capital,
Uh,
we'd like a percentage.
I see. Okay, okay, okay.
If you
Interesting.
use our platform, I mean, it's a little bit almost like an investment banking platform, right? We can expose, it's almost like, what we're able to show and provide is a like a prospectus, but with real-time data.
Mhm.
Um, and then we have all these monitoring tools for you to keep on monitoring these companies. So we think the value there is not insignificant, right? I mean, how much does an investment bank charge,
Yeah,
right,
yeah.
for securing capital? Quite a bit.
So,
Um, and they don't
so,
even monitor those companies after the deal's done.
so do you, so either cost of capital if they use the capital or no?
Yeah. So what we'll do is we'll take a cut. We'll take a
Ah,
2 point cut. All right.
okay.
So
Got
it
it, got it, got
isn't.
it.
Yeah.
Got it, got it. Oh, okay, now I see how it works. Okay, this is a bit more information. That's interesting. So essentially, you're taking a cut from the deal flow, which is normal, and then you're also buying part of the equity, right? I guess that's
One way to look at it, yeah, because the position we're taking is not an equity position necessarily in that fund. I mean, we could structure it that way. I mean, so the funds that are kind of working with us now, we have an equity stake in a couple of those funds. Um, but there are different arrangements, right? Some people might be toxic to that.
yeah.
And there could be different arrangements. It could be, hey, pay a fee for getting all your data on this platform and showing it. Okay.
Right, right, right.
And then if we secure capital, then you give us a cut of whatever is raised.
Right, 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 right. Okay, okay, okay,
Now
okay.
you can use that tool and go to your own investors and raise money on your own. Go for it. But yeah, and that's kind of the base rate, if you will, of so a percentage for all the capital that goes into the deals that are monitored by the system. But
Mm,
then second to that is, hey, any capital that we raise because of the aggregation can go into it. So remember, keep in mind that you have kind of two different structures that you generally don't fit very well. You have an individual embedded finance company,
right.
or even a fund manager that has a portfolio of companies. And then you have investors that want as much diversification as possible.
Yeah,
That doesn't fit very well, right?
yeah.
So what we're able to do is say, okay, here's a diversified portfolio.
Yeah.
Some of that money goes to this one fund manager, and some of it goes to this embedded finance company. So you get that diversification. And so the fund manager or embedded finance company, they might be able to go and use this platform we have to show people their performance, and
Right.
they can use it to raise money. Good for you. Great. Right.
Right.
And we take a small cut there. But if we are then going to different people, such as the Web3 world and raising from the Web3 world, so that now more money is flowing into your pot,
Mm-hmm.
we should get a percentage of that too.
Mm-hmm. 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 Wow. Okay. So many layers, finance guys.
Yeah.
That's
Well,
uh,
it's different value. It's different value, right?
it's definitely different value, and you're aggregating a lot of the normal, like the normal models I've seen out there together. Like you're actually right. You're actually
Yeah,
piecing it together. So yeah, yeah,
right, exactly.
yeah. Great. Okay. I think I really understand this space now. So
Oh,
thank you for
good.
very
I'm glad it was helpful, and I do hope that there will be viewers that are interested in at least the mission, if not our offerings, and be very happy to be connected to them.
right, right, exactly. Yeah, that's the process after that. So yeah, no, that's good. Thank you a lot for your time today, Jim.
Thank you.